The data we have just pulled directly from the CME Group servers is not just a statistical anomaly or routine market fluctuation. It represents a genuinely historical event that will be studied by commodity market analysts for decades to come. We are examining a delivery report that fundamentally changes the entire complexion and competitive landscape of the global silver market. For the last 48 hours, we have been consistently warning you that the Chinese export ban would systematically break the international supply chain. We warned you repeatedly that the major banks were trapped in unsustainable short positions. We warned you explicitly that the physical silver market was rapidly divorcing itself from the manipulated paper market. But what happened today at exactly 2:30 p.m. Eastern Standard Time goes far beyond any warning we could have realistically issued to our audience. We are witnessing the ghost of 1980 returning to haunt the trading floor. We are witnessing a coordinated physical grab for precious metal that we have not seen since the infamous days of the Hunt brothers attempting to corner the silver market. Ladies and gentlemen, this is Asian Guy, also known as John A.G. from Currency Archive. I have the official CME Group delivery report right here in front of me on my computer screen. Let's examine the raw numbers carefully because numbers absolutely do not lie, unlike the mainstream financial media. Today, Friday, January 2nd, the COMEX Exchange issued exactly 1,168 delivery notices. That represents 5,840,000 ounces of physical silver demanded in a single trading session. But if you zoom out just 24 hours, if you combine today's shocking report with the massive spike we documented yesterday on New Year's Day, the total number of contracts standing for delivery in the first 2 days of 2026 is 3,446 contracts. Let me repeat that staggering number again, slowly, so you can properly visualize the mountain of precious metal it represents. 3,446 individual contracts. Multiply that by 5,000 ounces per standard contract. That equals 17,230,000 ounces of physical silver moved in just 48 hours. To put this unprecedented demand into proper perspective, the global mining industry produces roughly 800 million ounces annually. That means in the first 2 trading days of the year, before most institutional traders have even returned from their holiday vacations, COMEX has been forced to cough up more than 2% of the entire annual global production. This is absolutely not commercial hedging by industrial users. This is definitely not normal industrial flow or routine supply chain management. A solar panel factory does not order 17 million ounces of silver on a Friday afternoon for immediate delivery. This is a sophisticated, coordinated, and violent run on the bank's physical inventory. This is a calculated raid on the exchange as precious metal stockpiles by entities that understand exactly what they're doing. You have to understand the critical significance of the timing. Why January 2nd? Why the desperate rush for immediate physical possession? Because, as of this morning, the Chinese silver export ban is officially live and fully enforced. The supply wall we've been discussing for months is now a concrete reality. The 400 million ounces of annual supply from the East has been completely cut to zero. And the financial sharks in New York understand this reality perfectly. They know that the 39 million ounces currently sitting in the registered COMEX vaults represent the last easily accessible ounces remaining on planet Earth. They know that once those ounces are gone, the price discovery mechanism breaks down completely and the market goes to no offer. So they didn't wait for better prices. They didn't attempt to dip their toes in gradually. They smashed the buy button with overwhelming force and demanded delivery of 17 million ounces instantly. They systematically stripped nearly half of the available registered inventory in just 2 days. If this aggressive pace continues for another 48 hours, COMEX breaks mathematically. It simply cannot survive another week of this relentless pressure from sophisticated institutional buyers. We are watching a complete inventory liquidation event disguised as a normal trading session. And the most terrifying aspect of this delivery report isn't just the unprecedented volume of physical demand, it is the clear intent behind these massive orders. When you witnessed 17 million ounces move in 1980, it was 2 brothers from Texas attempting to corner the entire market. Today, it isn't a couple of independent cowboys with oil money. It is the major banks themselves engaging in financial warfare against each other. We are witnessing a phenomenon that signals the definitive end of the price suppression cartel that has controlled precious metals markets for decades. We are seeing systematic cannibalization of the banking system. The major banks are no longer working together cooperatively to hold silver prices down through coordinated short selling. The gentleman's truce that has existed for 40 years is completely broken. They are now systematically eating each other alive to secure the limited number of financial lifeboats. When you examine the issuer and stopper data carefully, the detailed list of who sold the silver and who bought the silver, it reveals a brutal economic war taking place behind the closed doors of institutional trading desks, Usually, the major banks pass physical silver back and forth like a hot potato to keep the price suppression game going indefinitely. Bank A sells to Bank B sells to Bank C, and nobody actually takes the metal out of the vault system. It's purely a paper shuffle designed to create the illusion of adequate supply. But today, the music stopped abruptly, and the hot potato was frozen in place. The metal stopped moving in a circular pattern between cooperative allies and started moving in a straight line from one institution's vault directly into another institution's fortress. One major financial institution was forced to bleed precious metal. One major institution was forced to vomit up millions of ounces of precious inventory that they desperately needed to keep for their own survival. And another major institution, one that used to be their trusted ally in market manipulation, stood there with a bucket and caught every single drop. This is exactly what happens when a currency system begins to die. The thieves stop stealing exclusively from the general public and start stealing aggressively from each other. We are watching the complete breakdown of the gentleman's agreement that has systematically suppressed silver prices for 4 decades. There are no gentlemen left on Wall Street today. There are only predators hunting for survival and prey bleeding out on the floor of the exchange. So who is the victim in this financial bloodbath? Who is the issuer that just lost 3 million ounces of silver in a single trading day? And who is the blue whale predator that just swallowed 80% of the available market? The names on this delivery report will shock you because it turns out that the biggest buyer of physical silver right now isn't a Reddit community investor. It isn't a coin shop owner or small dealer. It is the very bank that created the paper short position in the first place. They're completely flipping the script on decades of market manipulation. They are switching sides in the middle of the battle, and they are systematically destroying their former competition to accomplish this strategic pivot. Let's examine the combatants in this unprecedented financial warfare. Let's analyze the blue whale raid that is reshaping global silver markets in real time. Deutsche Bank, the German financial institution that has been a cornerstone of European banking for over 150 years, just became the sacrificial lamb in this coordinated assault. They were forced to deliver approximately 3 million ounces of precious silver to their former allies, who turned into ruthless predators overnight. This represents the largest single-day forced delivery from a major bank since the commodity markets were deregulated in the 1970s. JPMorgan Chase, America's largest bank with over $3 trillion in assets under management, led this coordinated raid with the precision of a military operation. They did not just buy silver, they systematically stripped Deutsche Bank's inventory with the cold efficiency of a corporate liquidation. This wasn't a normal market transaction. This was financial warfare designed to cripple a competitor while securing scarce physical resources. And while these financial giants are feasting on the carcass of Deutsche Bank in the wholesale institutional market, systematically sucking up 4 million ounces of industrial bars before they can even reach the retail distribution network, the situation for ordinary investors, for you, for me, for the average American family trying to secure their savings in precious metals, has gone from merely difficult to completely impossible. We are witnessing a total blackout of the retail precious metals supply chain. If you think the institutional raid on COMEX was violent and unprecedented, you should see what is happening right now on the websites of major bullion dealers across America. It is a digital ghost town. The inventory has completely vanished. The physical shelves are completely bare. The traditional buy buttons have been replaced with "Notify me when available" buttons that may never be activated again. I have been monitoring the real-time inventory feeds of the 3 largest online precious metals dealers, SD Bullion, Kitco, and APMEX, since the market closed today. And the data confirms beyond any doubt that the retail Armageddon we feared and predicted is no longer a future forecast. It is here, it is happening right now, and it is accelerating. Let's start with SD Bullion, one of the largest volume dealers in the United States. They typically maintain inventory of tens of thousands of coins, ready for immediate shipment to retail customers. As of 7 p.m. Eastern Standard Time tonight, their product page for the current year American Silver Eagle displays a terrifying message: out of stock. But the situation gets significantly worse when you examine the details. Usually when they experience temporary inventory shortages, they provide customers with an estimated shipping date of perhaps 2 weeks maximum. Tonight, their estimate says next shipment March. We are currently in early January. They are explicitly telling potential customers that for the next 8 weeks minimum, there is absolutely zero inventory coming into their distribution network. Why? Because the United States Mint cannot obtain the silver blanks necessary for coin production. And why can't the U.S. Mint secure silver blanks? Because JPMorgan Chase just purchased all the available silver bars that the Mint typically uses to manufacture them. The blue whale literally ate the feedstock that supplies retail investors. Now let's examine Kitco, another major dealer with international reach. The The situation there is actually worse. When you navigate to their Silver Eagle product page, you don't even get a price quote. You get a grayed out box that simply says unavailable. They aren't even accepting back orders or taking customer deposits. They have closed their order book completely for an indefinite period. This is extremely significant because dealers typically love accepting back orders from customers. It provides them with interest-free loans and guaranteed future sales. When a dealer refuses to take your money for future delivery, it means they are genuinely terrified that they won't be able to source the physical metal at any price. They're afraid of defaulting on customer orders and facing legal liability. So they are choosing to shut down sales completely rather than take the financial risk. And then there is APMEX, often considered the dealer of last resort. They typically maintain inventory because they charge the highest premiums in the industry. They function as the true price discovery mechanism for desperate buyers willing to pay any price. And right now, they do have some Eagles in stock, but look at the price that reveals the true state of the market. I'm looking at the live listing for a single random year American Silver Eagle. The current price is $89.70. Let that sink in for a moment. $89. The COMEX spot price, the price that banks trade at in the wholesale market, is $71. That represents an $18 premium. That is a 25% surcharge just to get your hands on a single ounce of physical silver. To put this premium explosion in historical perspective, normal retail premiums during stable market conditions typically range from 3 to 5% over spot price. We are currently seeing premiums of 25%, which represents a 5-fold increase in the cost of accessing physical metal. This isn't price gouging by dealers. This is pure supply and demand economics. When inventory becomes scarce and demand remains strong, prices rise until demand is destroyed or supply increases. But here's the truly frightening aspect of the current retail market breakdown. Supply cannot increase because the source material has been completely captured by institutional buyers. The silver bars that would normally be refined into retail products have been purchased by JPMorgan and removed from the retail supply chain entirely. The most critical aspect of today's market action is not just the American delivery spike or the retail supply shortage. It's the confirmation that we are witnessing a synchronized global drainage of precious metals inventory. This isn't isolated to COMEX or limited to American markets. This is a worldwide phenomenon that suggests we've reached a tipping point in the global silver supply-demand balance. The total registered silver inventory in COMEX vaults as of this morning was 39 million ounces. After today's delivery spike of 17 million ounces over 2 days, nearly half of the available inventory has already been removed or earmarked for delivery. This means the vault now contains approximately 22 million ounces available for future delivery demands. But here's what makes the situation mathematically untenable. We haven't just seen 17 million ounces of demand disappear. That metal hasn't gone to industrial users who will consume it in manufacturing processes. It has gone to financial institutions who are removing it from the available supply permanently. That 17 million ounces has been sequestered by the banking cartel and will never return to the exchange inventory system. And if you think 39 million ounces sounds like a substantial amount of metal remaining, you are fundamentally mistaken about the mathematics of this crisis. We just witnessed 17 million ounces of demand in 48 hours. Now let's do the simple arithmetic. 39 million divided by 17 million equals approximately 2.3. At this current rate of institutional demand, at this current speed of bank-on-bank rating, COMEX has roughly 2.5 days of inventory remaining before it hits absolute zero. 2.5 days until the largest precious metals exchange in the world runs completely dry. We're not staring into a distant crisis. We're staring at the bottom of a nearly empty barrel. But the inventory collapse isn't just happening in New York. It's a synchronized global drain that suggests coordinated action by major financial institutions worldwide. We also received the nightly inventory numbers from the Shanghai Futures Exchange. Remember, China just reopened their markets today after the extended holiday period, and the moment the doors opened, the vacuum turned on with devastating effect. The total silver inventory in Shanghai vaults has fallen to 681 metric tons after losing 46 tons in a single trading session. Let's translate that into ounces for easier comparison. 46 tons represents roughly 1.5 million ounces. So on the very first day that the new export ban went into full effect, the Chinese domestic market consumed 1.5 million ounces of its own national stockpile. This confirms our worst fears about the Chinese market situation. The Chinese domestic market is in a complete panic. The industrial buyers in Shenzhen and the solar panel manufacturers in Jiangsu province are not waiting for better prices or more favorable market conditions. They are systematically looting their own exchange because they understand that the export ban means no new metal will be coming in from international sources, and they cannot get their domestic metal out to global markets. They are essentially trapped in a cage with a hungry tiger, and the only food remaining is that 681 tons of exchange inventory. At a depletion rate of 46 tons per day, the Shanghai Futures Exchange goes completely dry in exactly 14 trading days. Now let's examine the global mathematical picture. New York is bleeding 2.8 million ounces per day. Shanghai is bleeding 1.5 million ounces per day. That represents nearly 4.5 million ounces of physical silver vanishing from visible stockpiles every single trading day. Meanwhile, global silver mines only produce approximately 2 million ounces per day. We are currently running a daily deficit of 2.5 million ounces between consumption and production. The mathematics are completely broken. The buffer inventory that has allowed this market to function is disappearing. We are literally watching the major exchanges run out of deliverable product in real time, and there is no mechanism to replace it at current price levels. This is why JPMorgan panicked and launched their raid on Deutsche Bank. They see these inventory numbers before we do through their institutional trading connections. They saw the Shanghai drain beginning this morning. They saw the COMEX levels dropping to critical thresholds. And they realized that if they didn't grab the available metal from Deutsche Bank today, there wouldn't be any metal left available for purchase next week at any price. The inventory data we've analyzed represents the smoking gun evidence that proves this is not a speculative bubble driven by investor sentiment. This is a fundamental resource crisis. The world is literally running out of available silver at current price levels, and only a dramatic repricing event can potentially stop the bleeding of physical inventory from exchange vaults. And this brings us to the final critical conclusion that ties together all the evidence. We have documented the delivery spike, we have analyzed the bank raid, we have confirmed the retail outage, and we have calculated the vault drainage rates. What does all of this data mean for Monday morning when markets reopen? What does it mean for the long-term solvency of the global financial system? JPMorgan Chase just spent hundreds of millions of dollars to corner a significant portion of the available silver market. Are they at financial risk, or is the real risk located somewhere else entirely? Let's conclude this analysis with the bottom line financial calculations that reveal the true nature of this economic warfare. There's one critical question that is flooding my inbox right now from concerned investors. It's the question every End the Fed channel is asking across social media platforms. Is JPMorgan Chase bankrupt after this raid? Did this coordinated attack break the major banks financially? Is the entire system now insolvent? We need to approach this question as adults. We need to put away wishful thinking and examine the cold, hard arithmetic of major bank capital structures. Because if you misjudge the enemy's financial strength, you will lose this economic war. Let's analyze the risk mathematics of today's massive transaction. JPMorgan and Citigroup combined took delivery of 4.42 million ounces of physical silver today. At the current COMEX spot price of $71 per ounce, what is the total dollar value of that metal acquisition? Let's do the multiplication. 4.42 million times $71 equals approximately $314 million. Now, to you and me, $314 million represents an unimaginable fortune. It's enough money to buy a private island, a sports team, or a small country's annual budget. But to JPMorgan Chase, this represents pocket change. JPMorgan currently maintains $1.65 trillion in Tier 1 capital reserves. Citigroup holds roughly $240 billion in similar reserves. So let's calculate the actual percentage impact. $314 million represents exactly 0.02% of their combined safety buffer capital. Let me repeat that stunning figure, 0.02%. It is the financial equivalent of an average American buying a cup of coffee at Starbucks. It does not even dent their balance sheet. It does not threaten their solvency in any meaningful way. It does not trigger margin calls from Federal Reserve regulators. If you are waiting for JPMorgan to collapse financially because they had to spend $300 million on silver, you are going to be waiting for a very long time. They have the digital printing press of the Federal Reserve System behind them. They have essentially infinite liquidity access. The dollar squeeze theory that circulates in precious metals communities is largely a myth when applied to systemically important financial institutions. They will never run out of dollars because they can create dollars, and this is the most critical but of the entire year. While the financial cost of this raid was negligible to their balance sheets, the physical signal it sends is absolutely deafening to anyone who understands market dynamics. If the cost was so minimal, if $300 million is just pocket change for Jamie Dimon and JPMorgan's board of directors, why did they do it? Why did they break the unspoken truce with Deutsche Bank that has existed for decades? Why did they drain the registered vault to dangerously low levels? Why did they risk creating a retail panic that could spiral out of control? Because while they have infinite access to dollars, they know there is finite silver available on planet Earth. They raided the market today, not because they were forced to spend the money, but because they desperately needed to secure the physical metal. They know that the $314 million they spent today bought them 4 million ounces at current prices. But they also know that next week, that same $300 million might only purchase 2 million ounces, and next month, it might buy them nothing at all. This proves that the crisis is not about bank solvency or financial liquidity. It is about physical availability and resource scarcity. It represents a physical lockout where price becomes irrelevant. The major banks are effectively converting their worthless paper fiat currency, which they can print for free, into the only hard asset that China, Samsung, and Tesla are fighting over desperately. They are swapping fake assets for real assets at a speed we haven't witnessed since 1980. They are front-running the inevitable revaluation that occurs when paper markets divorce from physical reality. They are not the dumb money getting squeezed by market forces. They are the ruthless, smart money doing the squeezing. They are squeezing Deutsche Bank, they're squeezing retail buyers, they're squeezing industrial users, and they're gathering all the remaining chips on the table before the casino lights turn off permanently. And this completely redefines the battlefield for Monday morning when trading resumes. We are no longer looking at a traditional paper short squeeze where retail investors hope the price goes up so the banks lose money. The banks have already hedged their positions. They have already switched sides strategically. They are now long physical silver in massive quantities. We are looking at bank-on-bank warfare for survival. It's Deutsche Bank versus JPMorgan. It's Europe versus America. It's the financial haves versus the have-nots. And in this new paradigm of economic warfare, the spot price of $71 is just a meaningless number on a computer screen. It's a tool of deception and market manipulation. While the ticker says 71, the inventory data says critical shortage. While the ticker says 71, the retail supply chain says completely sold out. While the ticker says 71, the Shanghai Vault data says minus 46 tons and falling fast. So here's the bottom line for the first 48 hours of 2026. We have witnessed a 17 million ounce delivery spike, a level not seen in 46 years of commodity market history. We have witnessed the systematic cannibalization of a major European bullion bank. We have witnessed the complete closure of the retail distribution window, and we have witnessed the dangerous acceleration of global vault drainage. This is not a drill. This is not a practice exercise. The silver endgame scenario is now live and active. The physics of supply and demand have taken over from paper manipulation. The paper price is now completely irrelevant to market reality. The only thing that matters is physical possession. If you have it, you win. If you're waiting for a price dip, you lose. Because by the time the dip comes, all the inventory will be gone forever. Do not look at price charts. Look at vault data. Do not listen to Federal Reserve officials. Listen to the sound of 3 million ounces leaving Deutsche Bank's vaults. The war has officially started, and the banks just fired the first shots at each other.